Lost big in crypto? Don't let volatility wipe you out. In this video, we reveal proven risk management strategies to protect your portfolio and trade with confidence. Stay tuned to learn how to survive the crypto roller coaster.
Section 1. Why risk management matters. First things first, why bother with risk management? Crypto markets are notoriously volatile. Prices can skyrocket 50% in a day or crash just as fast due to news, whale movements, or regulatory shifts. Without a plan, you're gambling, not trading. Effective risk management helps you minimize losses, preserve your capital, and stay in the game long term. Think of it as your safety net in a high-wire act. Common risks include market volatility, where assets like Bitcoin can fluctuate wildly, liquidity risks in smaller altcoins, security threats from hacks or scams, and even psychological pitfalls like emotional decision-making. According to Fidelity, defining your investment objectives and assessing personal risk tolerance is key before jumping in. Research shows that traders who ignore these often blow up their accounts. But don't worry, we'll arm you with proven strategies to tackle them head-on.
Section 2. Core Risk Management Strategies. Let's break down the foundational strategies. We'll start with the basics and build up. Strategy 1. Diversify your portfolio. Don't put all your eggs in one basket, or in crypto terms, all your funds in one coin. Diversification means spreading your investments across different cryptocurrencies, like Bitcoin for stability, Ethereum for smart contracts, and maybe some altcoins for growth potential. You can even mix in stablecoins or traditional assets to hedge against crypto-specific downturns. The benefit? If one asset tanks, your whole portfolio doesn't go down with it. For example, during the 2022 market crash, diversified holders fared better than those all-in on speculative tokens. Trax recommends using crypto index funds for automatic diversification, rebalancing your holdings based on risk profiles. Aim for a mix, 50% in large caps like BTC and ETH, 30% in mid caps, and 20% in higher risk plays. Rebalance quarterly to keep things aligned.
Strategy 2. Use stop-loss orders. This is your automated exit door for bad trades. A stop-loss order sells your asset if it drops to a predefined price, capping your losses. For instance, if you buy ETH at $3,000, set a stop-loss at $2,700 to limit your downside to 10%. Why it works? It removes emotion from the equation and protects against sudden crashes like those flash dips in crypto. Advanced users can employ tiered stop losses, exiting portions of your position at different levels, say 33% at -5%, another at -10%. Changelly highlights how this accommodates volatility while locking in some profits. Always base placements on technical analysis like support levels to avoid getting stopped out too early. Strategy 3. Master position sizing. Never risk more than you can afford to lose on a single trade. The golden rule? Limit risk to 1 to 2% of your total capital per trade. If your portfolio is $10,000, that's $100 to $200 at stake, max. Explanation. Calculate position size using account size times risk percent divided by entry price minus stop-loss price. This ensures one loss doesn't derail you. Benefits include surviving losing streaks and compounding wins over time. OSL stresses this prevents account blowouts in volatile markets. For example, on a high volatility altcoin, size down even further to 0.5%. Strategy 4. Set a risk-reward ratio. Before entering any trade, define how much you're willing to risk versus potential gains. A common ratio is 1 to 3. Risk $1 to make $3. This means your winners need to outpace losers to stay profitable. How to apply it? Use technical tools like Fibonacci retracements or RSI to identify entry-exit points. BitMEX notes this disciplined approach keeps your trading edge sharp. Example, buying a coin at $10 with a stop at $9, risk $1, and target at $13, reward $3. Over time, even a 40% win rate can yield profits. Strategy 5. Do your own research, DYOR. Blindly following influencers or hype is a recipe for disaster. DYOR involves analyzing a project's fundamentals, like team, technology, tokenomics, and audits, plus technicals like charts and volume. Benefits: spots red flags early, avoiding rug pulls or overhyped coins. Cryptomus advises using checklists for structured evaluation. For instance, check smart contract audits on platforms like Certic before investing, combined with sentiment tools to gauge market mood without falling for FOMO or FUD.
Strategy 6. Use leverage wisely. Leverage lets you control larger positions with less capital, but it amplifies losses too. Stick to low levels like 2 to 5x and always factor it into position sizing. Why careful? A 10% move against you on 10x leverage wipes out your stake. Blueberry Markets warns to align leverage with risk tolerance and market conditions. Example, on a stable trade, use 3x. Skip it entirely for speculative plays. Strategy 7. Secure your assets and choose reliable platforms. Crypto hacks are real. Use hardware wallets like Ledger for long-term holds, enable 2FA, and trade on regulated exchanges with proof of reserves. Benefits? Protects against theft, which has cost billions. BitMEX boasts 0 hacks since 2014, emphasizing secure platforms. Diversify across exchanges and set price alerts for quick response.
Section 3. Advanced Tips in Psychology. Now for some advanced layers. Employ dollar cost averaging, DCA. Invest fixed amounts regularly, say $100 weekly in BTC, to average out costs and reduce timing risks. It's great for long-term holders, smoothing volatility as per Blueberry Markets. Hedging can offset losses. Use options or futures to bet against your holdings during downturns. BitMEX options are a tool for this across major coins. On the psychological side, avoid overtrading by sticking to a written plan with entry and exit rules. Take breaks if emotions run high. OSL calls this essential to prevent revenge trades. Keep a trade journal to review wins and losses weekly. Finally, use tools like technical analysis, moving averages, RSI, and fundamental checks like adoption rates for informed decisions. Trax integrates these for better forecasting.
To wrap up, risk management in crypto trading boils down to diversification, stop losses, smart sizing, DYOR, and emotional control. Implement these and you'll trade smarter, not harder. Remember, no strategy guarantees profits. Crypto involves risks, so only invest what you can lose. Consult a financial advisor if needed. If you found this helpful, hit that like button, subscribe for more crypto guides, and drop a comment. What's your top risk management tip? Check the description for links to the resources we referenced. Thanks for watching. Stay safe out there.